Have you ever wondered why some people spot golden opportunities while others walk past the same chance without noticing anything at all? It is not luck. It is not genius. It is a way of seeing. Peter Lynch, one of the greatest investors of all time, believed that the street you walk every day hides more treasures than Wall Street itself. The store you shop in, the restaurant you eat at, even the haircut chain around the corner could hold the next big stock winner. But here is the gap. If it is so simple, why do most people fail to see it? Why do ordinary eyes miss what an investor like Lynch sees? That is the secret this book reveals. Step by step, he takes us inside his journey from a curious boy in Boston to the legendary manager of the world's largest mutual fund. And it all begins in a place you would least expect. Not in New York, not in a financial center, but inside the humble classrooms of St. Agnes School. Now let us walk into Chapter 1, The Miracle of St. Agnes. Chapter 1, The Miracle of St. Agnes. Peter Lynch does not begin his story on Wall Street. He begins it in a modest neighborhood of Boston. Here stood St. Agnes, a Catholic school run by strict but compassionate nuns. At first glance, it was an ordinary school, but for Lynch, it was a place of miracles. Not the supernatural kind, but the kind that shaped his way of thinking. He remembers the discipline of the classrooms. The nuns demanded effort, neatness, and full attention. They taught him that no detail was too small to matter. If you did not complete your homework, they noticed. If you whispered in class, they noticed. This sharp attention to detail later became the foundation of his investing style. An investor must also notice the small signs that others ignore. At St. Agnes, Lynch also discovered the value of curiosity. The lessons were strict, but the atmosphere encouraged questions. Why does the world work the way it does? Why do some people succeed while others struggle? Why do prices go up and down? These small sparks of curiosity became seeds that later grew into a lifelong hunger for understanding businesses. One of the biggest lessons came from the contrast between limited resources and unlimited imagination. St. Agnes was not a wealthy school. The classrooms were plain. The supplies were basic. Yet the students were encouraged to think big. From these humble surroundings, Lynch learned that greatness often hides in ordinary places. This insight echoes in his famous advice: invest in what you know. Because what looks simple and everyday might contain the next giant opportunity. Lynch also recalls how community shaped him. St. Agnes was full of ordinary families who worked hard. They ran small shops, took regular jobs, and lived modest lives. Watching them gave Lynch respect for practical, hard-working people. Later, when he studied businesses, he always looked for that same grounded quality. Companies run by people who actually understood work, cost, and responsibility. But perhaps the greatest miracle of St. Agnes was this. It taught Lynch that knowledge is not something distant or mysterious. You do not need to be born into wealth to learn. You do not need a Wall Street address to see opportunities. You just need eyes that notice, ears that listen, and a mind that keeps asking why. This first chapter is more than a memory. It is a blueprint. Peter Lynch's later success with the Magellan Fund, his ability to beat the market again and again, all trace back to this early environment. From discipline, he learned patience. From curiosity, he learned to question. From ordinary surroundings, he learned to respect everyday opportunities. And this leads to the next step in his journey. Because while St. Agnes gave him the spirit of curiosity, the real test came later. When Lynch began facing the worries and doubts of actual investors, he realized something important. Most people do not lose money because they lack intelligence. They lose because they let worry control them. This is the theme of the next chapter. So now we move forward, from the miracle of a small school to the restless mind of the weekend worrier. Chapter 2, The Weekend Worrier. Imagine this scene. It is Friday evening. The market has closed. Investors should be relaxing with family, enjoying dinner, or planning a quiet weekend. But instead, many of them spend Saturday and Sunday worrying. They read newspapers filled with scary headlines. They hear television experts predicting disaster. They wonder if their money will vanish by Monday morning. Peter Lynch calls them the weekend worriers. Why do so many intelligent people fall into this trap? The answer is fear. Fear of losing money, fear of missing out, fear of not being in control. Lynch explains that markets are emotional machines. They rise and fall, not just because of profits or losses, but because human beings panic and celebrate in cycles. The weekend worrier is the perfect symbol of this emotional cycle. Lynch believed that worrying does not add $1 to your returns. In fact, it often destroys returns. Because when you worry, you act hastily. You sell a stock too early, you buy a stock out of panic, you follow rumors instead of facts. The weekend becomes a breeding ground for mistakes. He gives examples of how ordinary investors ruin themselves by trying to time the market. They sell after prices fall, thinking they are saving themselves. Then they buy back when prices rise, believing the danger is gone. In reality, they are always one step behind. They end up buying high and selling low, the exact opposite of success. What is the cure for weekend worry? Lynch's advice is both simple and powerful. Do your research. Once you know why you bought a stock, hold on to that reason. Do not let temporary fear erase a carefully thought-out decision. If you truly understand the company, a few bad headlines should not shake your confidence. He also warns against drowning in too much information. Reading 10 newspapers or watching endless news shows only makes you nervous. The more fear you consume, the more fear you feel. Instead, Lynch suggests focusing on the facts of the company itself. What is its business? How strong are its finances? Is it serving customers well? If those answers are positive, short-term panic does not matter. Lynch himself was never free of worry. He admits that even great investors feel doubt. But the difference is that he refused to let worry make his decisions. He used worry as a signal to double-check his research, not as an excuse to run away. This discipline separated him from the crowd. The weekend worrier teaches us a timeless lesson. The market does not reward anxiety. It rewards patience. It rewards calmness. And it especially rewards those who can hold their nerve when others lose theirs. But this raises a new question. If worry destroys so many investors, then what kind of system can protect them? How do large funds handle billions of dollars without collapsing under fear? To answer this, Lynch takes us behind the scenes of his own workplace. He invites us into the hallways of Fidelity, the fund house where he spent his career. Here we will see not only the machinery of mutual funds, but also the culture that kept panic in check. And so, we move from the restless mind of the weekend worrier to the structured world of the fund house. That is the journey of the next chapter. Chapter 3: A Tour of the Fund House. If you have ever wondered what happens inside a giant mutual fund company, Peter Lynch opens the door for you here. He takes us on a guided tour through Fidelity Investments, the place he called home for most of his career. For ordinary investors, mutual funds may feel like mysterious black boxes. Money goes in, decisions are made somewhere in hidden offices, and results appear later. But Lynch insists that a fund house is not a magic castle. It is a workplace of discipline, research, and relentless legwork. The first thing he reveals is the role of the analysts. Fidelity employed dozens of them, each responsible for studying a specific industry. These analysts were not ivory tower academics. They were detectives of business. They visited factories. They interviewed managers. They checked supply chains. They tried products themselves. This culture of investigation meant that ideas did not come from rumors, but from first-hand evidence. Lynch himself valued this teamwork. As the manager of the Magellan Fund, he relied on their reports, but never blindly. He would double-check by visiting companies himself. For him, the fund house was like a laboratory. Analysts brought in samples, and he tested them in real conditions. Only then would he decide if a stock deserved a place in Magellan. Another important lesson from the tour is that a fund house must combine both flexibility and discipline. On one hand, you need creativity. Analysts must be curious, willing to look at unusual companies or emerging sectors. On the other hand, discipline is crucial. There must be a system to filter out noise, to separate excitement from solid evidence. Without that discipline, a fund house would drown in random ideas. Lynch also describes the atmosphere of constant learning. At Fidelity, conversations were alive with debate. Analysts challenged each other. Managers asked tough questions. Everyone was expected to defend their ideas with facts, not with fancy words. This spirit of questioning created a culture where truth slowly emerged from argument. But Lynch makes one thing clear. Even in the best fund house, there is no certainty. Markets always carry risk. What the fund house does is prepare people to face uncertainty with knowledge. Instead of panicking like the weekend worrier, professionals at Fidelity tried to respond with research. The goal was not to eliminate risk, but to make intelligent choices despite it. For ordinary investors, this chapter is a window into professional money management. It shows that behind every fund, there are human beings struggling with the same doubts as everyone else. The difference is in method. Where individuals may rely on gossip or fear, a fund house trains its people to rely on legwork and discipline. Still, even within this structured world, challenges grew. For Peter Lynch himself, the real test came when he stepped beyond being an analyst and took on the responsibility of managing a fund directly. Suddenly, it was not just about studying companies. It was about making final decisions, carrying the weight of other people's money, and living with the consequences. This is where his true story as a fund manager begins. And so, from the guided tour of the fund house, we move into the next stage. Managing Magellan in its early years, when the fund was small, flexible, and full of potential. That is the journey of the next chapter. Chapter 4. Managing Magellan, the Early Years. When Peter Lynch first took charge of the Magellan Fund in 1977, it was a modest operation. The fund had only about $18 million under management. Compared to giant funds of Wall Street, it was a small boat in a vast ocean. But to Lynch, this small size was an advantage, not a weakness. It meant freedom. It meant flexibility. It meant he could move quickly, buy small companies, and test bold ideas without the weight of billions slowing him down. In these early years, Lynch began practicing his famous principle, invest in what you know. He believed that ordinary experiences in daily life were often better guides than Wall Street predictions. If a store was crowded with customers, if a restaurant chain was buzzing with energy, if neighbors were excited about a new product, that was worth investigating. Instead of chasing complicated theories, Lynch trusted common sense as the first signal. But common sense was never enough by itself. He combined it with deep research. If he noticed a promising company, he would dive into its balance sheet, study its growth, meet its managers, and test its products. The early Magellan Fund became a kind of personal laboratory where Lynch experimented with blending observation and analysis. One of the biggest advantages of running a small fund was agility. Lynch could buy shares in little-known companies before big investors even noticed them. He was not forced to buy only giants. This gave him access to hidden gems, companies that later multiplied many times in value. His portfolio in the early years often looked unusual to outsiders because it included small retail stores, regional banks, and niche businesses. But these unfashionable picks often turned into powerful winners. Of course, the early years were not free of mistakes. Lynch admits that some of his investments went badly wrong. He sometimes got carried away by exciting stories that had weak numbers behind them. But here too, he learned a lasting lesson. In investing, mistakes are unavoidable. What matters is not avoiding every error, but ensuring that the winners are strong enough to outweigh the losers. In the Magellan Fund, this philosophy became a guiding rule. Another important aspect of the early years was independence. Lynch often resisted the pressure to follow Wall Street trends. When everyone else was rushing into hot sectors, he quietly searched elsewhere. When experts warned him against certain industries, he asked his own questions instead of blindly accepting their judgment. This independence of mind became one of his greatest strengths as a manager. He also cultivated patience. Some of his early picks did not rise immediately. Months, sometimes years, passed before the market recognized their value. But Lynch stayed calm, trusting his research. He believed that time, not timing, was the real ally of an investor. Looking back, Lynch describes these years as a foundation. The small size of Magellan allowed him to sharpen his instincts, test his methods, and build confidence. The lessons he learned here prepared him for the much greater challenges that were waiting when the fund grew larger. And grow it did. From $18 million, Magellan began to attract attention and money. Soon, the fund was no longer a small boat, but a rising ship. Managing it became far more complex. The middle years of Magellan were marked by new challenges, greater responsibilities, and the pressure of handling massive inflows of capital. So now, we leave behind the flexible early stage and step into the stormy middle years. The period when Magellan became a giant, and Peter Lynch had to prove that his methods worked not just in theory, but under enormous weight. That is the story of the next chapter. Chapter 5: Magellan, the Middle Years. By the early 1980s, the Magellan Fund was no longer the small, agile boat Peter Lynch had first steered. It had grown into a massive ship carrying hundreds of millions of dollars. With this growth came a new set of challenges. Lynch could no longer simply buy small regional stocks that doubled overnight with a bit of luck. Now every decision mattered on a larger scale. The weight of responsibility was heavier, and the world was watching. The middle years of Magellan tested Lynch's philosophy in a new way. As the fund became larger, many experts predicted it would slow down. Big funds, they argued, could not keep growing as fast as small ones. Opportunities that once worked were now too small to make a difference. But Lynch refused to believe that size had to equal stagnation. He adjusted his style, widening his search across more sectors, industries, and even international markets. This was the era when his relentless research became legendary. Lynch did not stay trapped in an office. He traveled constantly, meeting managers, visiting companies, and walking through factories. He read annual reports late into the night, covering thousands of pages. His philosophy of legwork reached its peak. He often joked that his job was like being a detective, always chasing clues. The middle years also showed the strength of diversification. Lynch spread Magellan's holdings across hundreds of companies. Some criticized this as being too broad, but Lynch argued that it reduced risk while allowing hidden gems to shine. A few of those gems, when they multiplied in value, lifted the whole fund. It was proof that one did not need to bet everything on a handful of stocks. Another lesson from these years was humility. Even with all his research, Lynch still made mistakes. Some industries looked promising, but collapsed. Some companies had dazzling stories, but weak balance sheets. He learned that no one, not even the most celebrated manager, could be right all the time. What mattered was how he reacted. Instead of denying mistakes, he cut losses quickly and moved on. This flexibility helped Magellan continue to perform despite errors. During these middle years, the fund also faced market turbulence. Recessions, interest rate swings, and political shocks shook investors' confidence. Yet Lynch kept calm. He reminded himself and his team that downturns were temporary. He saw crashes not as disasters, but as shopping seasons, times to buy strong companies at discounted prices. This contrarian mindset separated him from the fearful crowd. Perhaps the most important transformation of the middle years was psychological. Lynch had to evolve from being a nimble stock picker into a large-scale manager of people and money. He carried the weight of millions of investors who trusted him with their savings. Every decision now carried emotional as well as financial pressure. And yet, instead of being crushed, he thrived under it. He discovered that discipline, humility, and curiosity could scale even when the fund became enormous. But the story of Magellan does not end here. The fund kept growing until it reached an unimaginable size, billions under management, the largest mutual fund in the world. The later years brought their own storms, far bigger than before. This was the ultimate test of Peter Lynch's philosophy and stamina. So now we step forward. From the demanding middle stage into the overwhelming later years of Magellan. The chapter where Peter Lynch had to prove not just his strategy, but his endurance. That is the story of the next chapter. Chapter 6. Magellan. The Later Years. The later years of Peter Lynch's time at the Magellan Fund were nothing short of historic. By this stage, Magellan had grown into the largest mutual fund in the world. Billions of dollars were flowing in, and every move Lynch made was closely watched by investors, the media, and even rival fund managers. Success had brought fame, but it also brought enormous pressure. Managing a fund of this size was not easy. With so much money under management, it became harder to find small, hidden gems that could meaningfully move the fund's performance. A stock that might double or triple in value was exciting, but unless the fund invested in it at a large scale, the impact on overall returns would be small. This was a new challenge Lynch had to adapt to. To tackle this, he sharpened his strategy. He divided stocks into categories: stalwarts, fast growers, cyclicals, turnarounds, and asset plays, so he could balance the portfolio and capture growth in different ways. This system allowed him to stay flexible even as the fund ballooned in size. He continued to rely on his core principle: doing deep research, walking through stores, visiting companies, and talking with managers. The art of investing for him was always linked with the science of legwork. Despite the challenges, Magellan's performance remained extraordinary. Year after year, Lynch continued to beat the market, proving that his approach worked not just in theory, but in practice at the highest level. Investors trusted him because he explained things in a way that ordinary people could understand. He reminded them that investing was not about complex equations, but about common sense, patience, and curiosity. But with success came sacrifice. Lynch often worked long hours, studied hundreds of reports, and traveled constantly. The pressure of handling so much money began to take a personal toll. He started thinking about balance, not just in portfolios, but in life. Eventually, this reflection would lead to his decision to retire while still at the top of his game. The later years of Magellan showed that even the biggest fund in the world could be managed with discipline and creativity. Lynch's track record became legendary, inspiring a generation of investors to look beyond Wall Street jargon and focus on what truly matters: knowing what you own and why you own it. Yet, behind all the numbers and records, there was a deeper question. Was investing simply a science, driven by data and formulas, or was it an art, shaped by instinct, creativity, and human judgment? That question takes us directly into the next chapter. Chapter 7. Art, Science, and Legwork. Investing, Peter Lynch insists, is both an art and a science. It is not enough to study numbers alone, nor is intuition by itself sufficient. The best investors combine both. They analyze balance sheets, revenue growth, and debt ratios, but they also trust their instincts, observations, and insights. This delicate balance is what separates ordinary investors from those who truly beat the market. Lynch often compares investing to detective work. Every company, every stock hides clues. Some are obvious: earnings reports, profit margins, market share. Others are subtle: a crowded store, a new product gaining attention, or a manager's genuine enthusiasm. The skill is in seeing both sets of clues and connecting them intelligently. Legwork is where the art meets the science. Lynch was famous for walking through shopping malls, visiting factories, and testing products himself. He would talk to customers, employees, and suppliers. He believed that first-hand observation often revealed insights that numbers alone could not show. A simple visit to a store could highlight trends before Wall Street recognized them. This was the core of his "invest in what you know" principle. He also emphasizes the importance of asking the right questions. A financial statement can be interpreted in many ways. Only by digging deeper can you separate real opportunities from illusions. Questions like, is this company really growing, or just appearing to grow through debt? Or, is management honest and capable? Are crucial. Lynch's skill lay in combining data analysis with human judgment to arrive at a clear picture. The chapter also teaches patience and persistence. Art, science, and legwork are not one-day tasks. They require consistent effort, curiosity, and time. Many investors fail because they expect instant results or rely solely on tips and predictions. Lynch's method is slower, but far more reliable. Importantly, he shows that investing is not confined to Wall Street offices or financial reports. Everyday life can provide signals and opportunities. A new trend in retail, a growing restaurant chain, or even a product you personally enjoy can become a clue for a profitable investment. The key is to notice, investigate, and verify. By the end of this chapter, the reader realizes that successful investing is not magic. It is a disciplined blend of observation, analysis, and judgment. Numbers matter, but so do the senses and the mind's curiosity. This is what allows ordinary investors to spot extraordinary opportunities. And this naturally leads to the next step. Because once you understand how to combine art and science, you need to know where to look. The next chapter takes us into one of the richest sources of opportunity: retail companies. Chapter 8: Shopping for Stocks, the Retail Sector. Peter Lynch had a simple rule: invest in what you know. And there is no better classroom than the everyday world around you. Retail stores, malls, and shopping streets can reveal opportunities before Wall Street notices them. The key is paying attention. A crowded store, a product flying off shelves, or a brand that keeps growing quietly can all signal a successful company. Lynch explains that ordinary consumers are also the best analysts. If you notice a store always busy, or a product consistently popular, that is valuable information. You do not need fancy formulas to spot growth. Your own experience as a shopper can guide your investment choices. He shares examples where his personal observations led to profitable investments. Sometimes a local store or restaurant chain that seemed ordinary became a major winner. Other times, trends that looked exciting at first glance failed to produce results. The difference was in careful research. Observing a store is the first step. Verifying sales, profits, and management quality is the second. Retail is also a sector that reflects human behavior. People's preferences, habits, and loyalties shape which businesses succeed. Trends can start small, like a local fad, and grow into nationwide demand. Lynch emphasizes that timing is less important than recognizing consistent growth and strong fundamentals. Another advantage of retail investing is transparency. Unlike secretive industries, retail businesses are often visible. You can see the customers, test the products, and measure popularity firsthand. This allows investors to make decisions based on observation, not rumors. Lynch warns, however, that popularity alone is not enough. A busy store does not guarantee profit. Some companies spend too much on expansion or mismanage costs. That is why combining first-hand observation with financial analysis is essential. You must understand the balance sheet, cash flow, and competitive position. Retail also teaches patience. A new trend may take months or even years to become profitable. Early investors who understand the underlying business and stay calm often reap significant rewards. Lynch calls this the magic of spotting opportunities before the crowd catches on. By the end of this chapter, readers understand that the retail sector is a goldmine for the observant investor. It requires curiosity, diligence, and patience. Every mall, street, and local store could hide the next big investment. But retail is not always easy. Sometimes bad news, downturns, or industry problems disguise opportunities. Knowing how to spot hidden value when the world panics is the next skill Lynch shares. And that brings us to the next chapter. Chapter 9: Prospecting and Bad News: How the Collapse in Real Estate Led Me to Pier 1, Sunbelt Nursery, and General Host. One of Peter Lynch's most powerful lessons is that opportunity often hides in bad news. When headlines scream disaster, most investors run in fear. But for those who dig deeper, these moments can become the best times to invest. This chapter tells how Lynch discovered gems during a period of real estate turbulence. In the early 1980s, the real estate sector faced a collapse. Property values were falling, construction companies struggled, and many investors panicked. Wall Street analysts warned of doom. Yet Lynch did not retreat. He saw potential where others saw only risk. He explains the process step by step. First, he identified companies that were fundamentally strong despite industry troubles. Next, he checked whether their management was competent and honest. Finally, he assessed whether the stock price reflected the fear-driven market or the true value of the company. This method led him to Pier 1, a retail company selling imported home goods. Though the economy was struggling, the company's business model was sound, its growth consistent, and its stores profitable. Similarly, Sunbelt Nursery and General Host appeared beaten down, but Lynch saw opportunity. Sunbelt had strong local demand for landscaping products, and General Host owned undervalued properties with steady cash flow. By investing during pessimistic times, the Magellan Fund could buy these stocks at discounted prices. Later, as conditions improved, these companies contributed significantly to the fund's growth. This chapter illustrates an essential investing principle. Do not fear temporary setbacks. Markets are emotional and often exaggerate problems. Savvy investors learn to separate the temporary from the permanent. A company struggling due to industry-wide issues may still thrive if it has strong fundamentals and capable management. Lynch also emphasizes research and patience. Buying during bad news is only profitable if you understand the business. Blindly chasing falling stocks can be disastrous. One must carefully evaluate the numbers, assess risks, and remain patient until the market corrects itself. Ultimately, prospecting in bad news is about courage. It is about looking where others avoid, trusting your analysis, and ignoring the panic around you. Many investors miss the best opportunities because they follow the headlines instead of following facts. By the end of this chapter, the reader understands that fear is not the enemy, ignorance is. Knowing how to spot value during a downturn transforms panic into profit. But even the most careful investor faces moments of extreme risk. Sometimes mistakes happen, and a close call teaches a lesson that lasts a lifetime. This brings us to the next chapter. Chapter 10. My Close Shave at Supercuts. Even the most experienced investors are not immune to mistakes. Peter Lynch shares one of his closest calls at Supercuts, a growing hair salon chain. At first glance, it seemed like a perfect opportunity. The brand was expanding rapidly, customers loved it, and the business model appeared strong. Lynch was tempted to invest heavily. But something felt off. Despite the growth, he noticed subtle warning signs: franchisee complaints, inconsistent quality between locations, and rising competition raised questions. He did not ignore these signs, but he almost overlooked them in his excitement. This near miss became a valuable lesson in humility and diligence. Lynch emphasizes that no amount of research can guarantee success. Even with careful analysis, a stock can go wrong due to factors beyond your control. What matters is the process, not perfection. He had almost invested in Supercuts without fully understanding the long-term risks. By taking a step back and re-evaluating, he avoided a potential loss. The Supercuts story also highlights the importance of attention to detail. Small red flags, if noticed early, can prevent major mistakes. Lynch constantly stresses that investors must not get blinded by hype or growth alone. Even a popular company can be a bad investment if the fundamentals are weak. This episode reinforces another lesson: patience and timing matter. Rushing into an investment because it looks exciting can be dangerous. Lynch advocates waiting for the right moment when the company's value aligns with its stock price. Discipline and caution are just as important as curiosity and legwork. The chapter concludes with a broader message. Investing is as much about avoiding mistakes as it is about spotting opportunities. Every near miss, every lesson learned, sharpens the investor's judgment. Supercuts became a story not of lost money, but of gained wisdom. But even after avoiding this mistake, Lynch never stopped looking for unusual opportunities. Sometimes, the most unexpected companies, in the strangest industries, turn out to be the most profitable. This brings us to the next chapter, where he explores overlooked businesses thriving in challenging industries. Chapter 11. Blossoms in the Desert. Great companies in lousy industries. Not every great investment exists in a glamorous industry. Peter Lynch often found his best opportunities in places that Wall Street ignored. These were the lousy industries. sectors considered boring, declining, or unexciting. Yet within them, hidden gems bloomed, like flowers in a desert. Lynch explains that most investors avoid such industries because they assume poor prospects. If an industry has a bad reputation, they think all companies within it will fail. This conventional wisdom creates opportunity. Stocks that are overlooked often trade at lower prices than their actual value. For investors willing to dig deeper, the potential rewards are enormous. He shares examples where careful research uncovered these hidden treasures. Some companies had strong management, loyal customers, and consistent cash flow, even in struggling sectors. They survived downturns, grew slowly but steadily, and eventually delivered remarkable returns. The key was patience and a focus on fundamentals rather than hype. One lesson Lynch emphasizes is the danger of assuming an industry's reputation defines a company's success. Even in a weak sector, a well-run business can thrive. Investors must evaluate each company on its own merits: profits, growth, balance sheets, and management quality. It is not about avoiding lousy industries, but about identifying the exceptional performers within them. These blossoms in the desert often require courage to invest in. Other investors are skeptical, media coverage is scarce, and analysts may ignore the sector. But those willing to see beyond the surface and trust their research can find extraordinary gains. Lynch also notes that these opportunities often provide a margin of safety. Because the stocks are unloved and undervalued, the downside is often limited while the upside potential is high. Investing in these overlooked companies allows patience to compound into substantial profits. By the end of this chapter, readers understand a crucial truth. Opportunity is not always obvious. Sometimes it lies where no one else is looking. The skill is in noticing, analyzing, and acting with conviction. It is in recognizing that even in barren industries, life and profit can flourish. But even after finding overlooked opportunities, the challenge remains: determining the true value of a stock. When is a company not just good, but a truly wonderful buy? This question leads naturally into the next chapter. Chapter 12. It's a wonderful buy. Peter Lynch believed that the ultimate goal of investing is to find stocks that are not just good, but exceptional. What he calls wonderful buys. A wonderful buy is a company that combines strong fundamentals, growth potential, and a reasonable price. It is a stock that you would be proud to own for years, not just a quick trade to chase market trends. Lynch explains that these companies often share certain characteristics. They have competent and honest management, a clear and sustainable business model, and a history of consistent earnings growth. They often operate in industries with barriers to entry, protecting them from new competitors. And crucially, their stock price is reasonable compared to their intrinsic value. Finding a wonderful buy requires research and patience. It is not enough to rely on market hype or media recommendations. Lynch emphasizes observing the company in action, reading financial statements, and understanding how the business earns its money. Only then can you distinguish a truly wonderful stock from one that simply appears attractive. He shares stories of companies that seemed ordinary but became exceptional investments. These were firms that the market initially overlooked, undervalued, or misunderstood. By recognizing their potential early, Lynch and the Magellan Fund were able to buy shares at favorable prices and hold them as they grew. Another key lesson is that a wonderful buy often offers a margin of safety. This means the stock is priced lower than its true worth, providing protection against mistakes or market downturns. Even if the market experiences volatility, the fundamentals of a wonderful company help it survive and eventually thrive. Lynch also cautions against overpaying. No matter how strong a company is, buying at a high price reduces future gains. Patience is critical. Wait for a price that aligns with the company's value and growth potential. This discipline separates successful long-term investors from those who chase quick profits. By the end of this chapter, readers understand that finding wonderful buys is the core of successful investing. It is about blending careful research, observation, and judgment to identify companies that can grow steadily over time. It is not glamorous work, but it is highly rewarding for those willing to put in the effort. Yet, even wonderful buys can face unexpected challenges. Some sectors or companies may falter due to macroeconomic shifts or regulatory changes. That is why investors must also understand broader trends and industry-specific risks. This leads naturally into the next chapter, where Lynch explores one such sector under scrutiny: the savings and loan institutions, or S&Ls. Chapter 13, A Closer. Look at the S&Ls. In the early 1980s, the savings and loan industry, often called S&Ls, was in turmoil. Many institutions were struggling under bad loans, rising interest rates, and poor management. To most investors, this sector seemed risky and unattractive. Yet Peter Lynch saw a mix of danger and opportunity. He explains that not all S&Ls were the same. While some were poorly managed and on the brink of collapse, others were solid, profitable, and undervalued. The key was separating the weak from the strong. Lynch studied balance sheets, loan portfolios, and management quality carefully. He wanted to understand which institutions could survive the turmoil and which would fail. This chapter teaches the importance of industry analysis. Markets often group companies together, assuming all firms in a troubled sector are bad investments. Lynch warns against this mentality. Individual company fundamentals matter more than broad sector sentiment. He shares examples where Magellan invested selectively in S&Ls that were overlooked by others. These institutions had strong capital, conservative lending practices, and competent leadership. Even during industry-wide panic, their stocks were priced attractively. By identifying these opportunities, the fund could profit while avoiding the sinking institutions. Another lesson is the importance of understanding risk versus reward. Investing in distressed sectors carries higher risk, but also higher potential returns. Lynch emphasizes the value of careful research to minimize risk and maximize reward. Blindly following panic, he says, is the fastest way to lose money. This chapter also highlights patience and timing. Even strong S&Ls faced temporary setbacks due to broader economic conditions. Investors needed to hold their positions long enough to let fundamentals shine through. Those who panicked during short-term turbulence often missed the eventual gains. By the end of the chapter, readers understand that troubled industries can hide valuable opportunities. The secret is diligent analysis, selective investing, and patience. It is about looking beyond fear and headlines to see the company's true potential. But financial instruments are not limited to traditional stocks or S&Ls. There are alternative investments that can provide steady income and attractive returns. This leads us to the next chapter, where Lynch explores one such opportunity: Master Limited Partnerships. Chapter 14, Master Limited Partnerships. A deal with a yield. Master Limited Partnerships, or MLPs, are a unique type of investment that combine the benefits of a publicly traded company with the tax advantages of a partnership. Peter Lynch found these instruments fascinating because they offered steady income through high yields while still providing growth potential. For many investors, MLPs seemed complicated or confusing, which meant they were often overlooked. But Lynch saw opportunity in what others ignored. He explains that MLPs are often involved in industries like energy, pipelines, and natural resources. These are businesses that generate consistent cash flow, even during economic ups and downs. Because they are structured as partnerships, much of the income flows directly to investors, making them attractive for long-term income seekers. Lynch emphasizes the importance of understanding the business model. Not all MLPs are created equal. Some have strong management, predictable revenues, and minimal debt. Others carry higher risk, especially if their cash flow depends on volatile commodity prices or speculative projects. The challenge is separating the solid performers from the risky ones. Another lesson is the power of yield. A high-yielding investment can generate significant income while waiting for capital appreciation. Lynch compares this to planting seeds that produce fruit every season while growing into a bigger tree. This makes MLPs particularly attractive for investors who want both steady income and long-term growth. He also warns that, like all investments, MLPs require research and monitoring. Economic shifts, regulatory changes, and management decisions can impact returns. Investors must understand the underlying business and not rely solely on the yield as a measure of safety. By carefully selecting MLPs with strong fundamentals, Lynch was able to add a unique dimension to the Magellan Fund. They complemented traditional stocks, reduced volatility, and provided consistent income. For ordinary investors, this demonstrates the value of exploring alternative investments that may lie outside conventional stock picking. By the end of this chapter, readers see that clever investors can find opportunities in overlooked structures, not just traditional companies. It is about understanding mechanics, evaluating risk, and seizing opportunities others ignore. But even structured deals like MLPs are not immune to the cyclical nature of business. Industries rise and fall, and successful investing often requires recognizing patterns and timing cycles. This naturally leads into the next chapter, where Lynch explores cyclical stocks. Chapter 15. The Cyclicals. What goes around comes around. Some industries move in predictable cycles. Peter Lynch calls these the cyclicals, sectors like automobiles, steel, chemicals, and construction that rise and fall with the economy. Understanding these cycles is key to making profitable investments. Invest at the wrong point in the cycle, and even a strong company can lose value. Buy at the right time, and gains can be extraordinary. Lynch emphasizes research and observation over guesswork. Cyclicals are driven by supply and demand, interest rates, and economic conditions. Studying past cycles can provide clues, but timing is never perfect. The goal is to identify companies that are financially strong and can weather downturns. These firms often bounce back faster and reward patient investors. He shares examples from the Magellan Fund where cyclical stocks became winners. Some companies were temporarily depressed due to low demand, but had solid management and cash flow. Investing in these stocks before the recovery allowed the fund to benefit when the economy rebounded. Others were mismanaged or over-leveraged and failed, reinforcing the need for careful analysis. Another key lesson is the importance of patience and flexibility. Cyclical investing requires holding positions through temporary declines and resisting panic. It also involves knowing when to exit before a peak passes. Lynch stresses that understanding the cycle helps manage both risk and opportunity. Cyclicals also teach a broader principle: markets are emotional. Investors often overreact to bad news, pushing prices lower than fundamentals justify. Savvy investors use this emotional bias to their advantage. Recognizing patterns in human behavior, as well as economic trends, is central to Lynch's approach. By the end of this chapter, readers understand that cyclicals can be highly profitable if approached with discipline. It is about combining industry knowledge, company analysis, and timing. Investing is not just about numbers. It is about understanding the rhythms of the market and the economy. But sometimes, even with cycles understood, companies face extraordinary stress. Disasters, mismanagement, or over-leverage can create distressed opportunities. This leads us into the next chapter, where Lynch finds value in troubled companies in the utility sector. Chapter 16. Nukes in Distress, CMS Energy. Not all great investments are obvious or glamorous. Sometimes, opportunity lies in companies facing serious challenges. Peter Lynch tells the story of CMS Energy, a utility company in distress, to illustrate this principle. The company operated nuclear power plants and faced public fear, regulatory hurdles, and financial strain. To most investors, it was too risky. But Lynch saw hidden value beneath the headlines. CMS Energy had strong fundamentals that many overlooked. Its cash flow was stable despite the industry's bad press, and management was experienced and focused on improving efficiency. Lynch examined the balance sheets, debt levels, and operational costs carefully. He identified that the market had overreacted to fears about nuclear energy, discounting the company's true worth. This chapter teaches a key investing lesson. Fear creates opportunity. When investors panic, prices fall, sometimes far below intrinsic value. Savvy investors who understand the business can buy quality companies at bargains. CMS Energy was one such case, a distressed stock with hidden potential. Lynch also highlights the importance of patience and timing. Distressed companies take time to recover. Investors must hold on through negative sentiment and short-term volatility. It is not about chasing quick profits, but understanding the long-term prospects of a company. He shares the broader insight that industries in trouble often hide diamonds. Energy, utilities, and other regulated sectors may face temporary setbacks, but the strongest players eventually rebound. The key is separating the weak from the strong and not being influenced by panic or media hype. The CMS Energy experience reinforced another principle for Lynch: do your homework and trust your analysis. Even if the market doubts your conclusions, careful research gives you confidence to act when others hesitate. This disciplined approach turns fear and uncertainty into opportunity. By the end of this chapter, readers see that investing is not just about following trends. It is about finding hidden gems in unlikely places and having the courage to invest when others are fleeing. But opportunities are not always found in distress alone. Sometimes, governments themselves create openings through auctions or sales. This naturally leads into the next chapter: Lynch's experiences with Uncle Sam's garage sale. Chapter 17: Uncle Sam's Garage Sale, Allied Capital II. Peter Lynch often found investment opportunities where others least expected them. One such opportunity was what he calls Uncle Sam's Garage Sale, where the government sells assets or companies at discounted prices. Allied Capital II became a prime example. The market overlooked it, seeing only a complex financial structure and bureaucratic involvement. Yet Lynch recognized the value hidden beneath the surface. The key to this strategy is understanding why the sale exists. Government sales often occur due to regulatory requirements, political pressure, or the need to raise cash quickly. These reasons are unrelated to the intrinsic value of the asset itself. A careful investor can evaluate the fundamentals and identify bargains that the market has ignored. In the case of Allied Capital II, Lynch studied the company's assets, management, and earning potential. Despite the complicated setup, the core business was solid. By buying during the government sale, the Magellan Fund acquired shares at prices far below their actual worth. This created a significant upside when the market eventually recognized the company's true value. This chapter highlights a broader lesson. Opportunity often lies in complexity. While many investors shy away from intricate structures, those willing to do the homework can find exceptional returns. Lynch emphasizes patience, research, and a clear understanding of what you are buying. The more others are intimidated by complexity, the greater the potential for a well-informed investor. He also stresses the importance of timing. Government sales can attract sudden attention, and prices can fluctuate quickly. Acting decisively once the analysis is complete is crucial. Procrastination can mean missing out on undervalued opportunities. By the end of this chapter, readers understand that bargains exist everywhere if you know where to look. Whether distressed companies, overlooked sectors, or government auctions, the principle is the same. Find value where others see risk. It is a lesson in courage, analysis, and patience. But investment opportunities do not stop with companies or auctions alone. Sometimes, the most lucrative returns come from large, stable institutions that are misunderstood or mispriced. This leads naturally into Lynch's experiences with Fannie Mae, one of the most interesting and misunderstood financial institutions of the time. Chapter 18: My Fannie Mae Diary. Fannie Mae, the government-backed mortgage giant, was often misunderstood by investors in the 1980s. Many saw it as just another financial institution, subject to regulation and bureaucracy. Peter Lynch, however, saw a hidden opportunity. By carefully studying its structure, earnings, and role in the mortgage market, he realized that Fannie Mae was a stable, undervalued asset with enormous potential. Lynch explains that Fannie Mae's value lay in its unique position. As a quasi-government entity, it had access to capital at favorable rates and a steady stream of mortgage-related income. Unlike conventional banks, it was insulated from some risks while maintaining strong profitability. This made it an attractive long-term investment for those willing to understand the details. One of the key lessons from this chapter is the importance of understanding the business model. Fannie Mae's operations were complex, involving mortgage securitization, government guarantees, and regulatory oversight. Many investors avoided it because they didn't fully understand the mechanics. Lynch, however, studied the reports, attended meetings, and kept a diary of insights. This diligence allowed him to see value where others saw confusion. He also emphasizes patience and discipline. Government-related companies can be volatile in the short term due to political or regulatory news. But long-term performance is driven by fundamentals. Lynch's diary approach helped him track developments and make informed decisions, avoiding impulsive reactions to headlines. Another key takeaway is that stable, misunderstood institutions can be undervalued. While the market often focuses on flashy growth stocks, slow-moving, reliable companies can offer consistent returns. Fannie Mae exemplified this principle, providing steady performance and compounding wealth over time. By the end of this chapter, readers understand that value often hides in plain sight. It requires effort to decode complex institutions, patience to ride out volatility, and discipline to stick with strong fundamentals. The diary approach, careful tracking, analysis, and reflection, becomes a model for long-term investing. But even stable institutions are not the only source of hidden wealth. Sometimes, immense value exists in overlooked markets and sectors closer to home, right in your own backyard. This leads naturally into the next chapter, discovering treasures in mutual funds and smaller companies. Chapter 19, Treasure in the Backyard, the Colonial Group of Mutual Funds. Sometimes, hidden investment opportunities are not exotic stocks or distressed companies, but overlooked gems in familiar places. Peter Lynch calls this treasure in the backyard. One example is the Colonial Group of Mutual Funds. While mutual funds were widely available, some were undervalued, mismanaged, or misunderstood, creating opportunities for savvy investors. Lynch emphasizes that not all mutual funds are equal. Many were overlooked because they lacked media attention, had low assets, or operated in smaller markets. Yet some funds had strong management, solid performance, and portfolios full of high-quality stocks. These were treasures waiting to be discovered by patient investors. He explains the process of evaluating these funds. It starts with understanding the holdings, the actual companies in the portfolio. Then comes management quality, how decisions are made, how risks are controlled, and whether growth is sustainable. Finally, price matters. A fund can be excellent, but if it trades at a high premium, the upside is limited. The Colonial Group was a prime example of overlooked value. By carefully analyzing its portfolio and management, Lynch identified strong positions in companies poised for growth. Investing in these funds allowed the Magellan Fund to indirectly benefit from multiple high-quality companies at favorable prices. This approach minimized risk while maximizing potential returns. Another lesson from this chapter is the importance of local knowledge. Sometimes, opportunities exist close to home, where investors can observe trends and gather insights firsthand. Whether it is a regional retailer or a local mutual fund, being observant and doing the research gives an edge over distant investors. By the end of this chapter, readers understand that treasure often lies where few look. It is not always exotic or dramatic. Sometimes it is in everyday investments, waiting for someone to recognize their true potential. The key is diligence, patience, and a willingness to explore beyond the obvious. But investing is not just about funds or overlooked gems. It also extends to industries we interact with daily, where personal experience can reveal hidden opportunities. This leads into the next chapter, where Lynch explores one of the most relatable sectors, restaurants. Chapter 20, The Restaurant Stocks, Putting Your Money Where Your Mouth Is. Peter Lynch often said the best research can come from your own life. Restaurants are a perfect example of this principle. Every meal you eat, every restaurant you visit, can provide clues about which companies are worth investing in. If a chain is consistently busy, customers are happy, and management runs operations efficiently, it could signal a profitable business. Lynch emphasizes that personal observation is powerful. Unlike complex industries, restaurants are visible. You can see how well they serve customers, track trends, and notice expansion plans. These everyday experiences can guide investors toward profitable stocks before Wall Street catches on. He shares stories where his own experiences at local restaurants led to successful investments. Chains that seemed ordinary to outsiders were actually growing steadily, maintaining quality and building loyal customer bases. Conversely, some popular restaurants appeared busy, but had underlying problems like poor management or financial instability. The lesson: observation must be paired with research. Another key takeaway is the importance of brand loyalty and consistency. Restaurants succeed not just by attracting customers once, but by keeping them coming back. Companies that maintain quality across locations and offer a positive experience often outperform competitors. Lynch calls this a recipe for success in the stock market as well. Timing and patience also matter. Restaurants may experience slow periods or temporary setbacks, but strong businesses tend to rebound. Investors who understand the fundamentals and ignore short-term noise can benefit significantly. By the end of this chapter, readers understand that the principles of investing are everywhere, even in everyday experiences like dining. Observation, research, and patience turn ordinary interactions into extraordinary insights. You learn to spot quality businesses before others do, making informed investments based on real-world evidence. But even after finding promising companies, disciplined investors know the importance of regular review and checkups. Stocks need ongoing monitoring to ensure they remain strong investments over time. This leads naturally into the final chapter, where Lynch emphasizes the importance of ongoing evaluation. Chapter 21: The 6-Month Checkup. Peter Lynch emphasizes that investing does not end with buying a stock. The work begins once you own it. He calls this the 6-month checkup, a disciplined review to ensure your investments remain strong and aligned with your goals. Even great companies can face challenges, and a vigilant investor must monitor performance regularly. Lynch explains that the checkup involves both quantitative and qualitative analysis. Look at financial statements, earnings growth, and cash flow trends. Check whether management continues to operate competently and whether the company is meeting its targets. Also, observe the business environment, industry trends, and competition. Changes in these factors can affect future performance and may require adjusting your position. Another key principle is avoiding emotional decisions. Investors often panic during temporary declines or get overexcited during short-term gains. Lynch stresses the importance of evaluating companies calmly and objectively. The 6-month review is not about reacting to every market move, but about understanding whether fundamentals remain intact. He shares practical tips for making the checkup routine. Set reminders to review holdings, compare them with peers, and update your notes on each company. Keep track of both successes and mistakes. Learning from past decisions strengthens future judgment. Lynch compares this process to a doctor's checkup. Regular monitoring prevents small problems from becoming serious issues. The chapter also reinforces the idea of patience and long-term thinking. Investing is a journey, not a sprint. Even the best stocks may have periods of underperformance, but disciplined monitoring allows you to stay invested in quality companies. It is the combination of careful research, observation, and consistent review that produces compounding returns over time. By the end of the book, readers understand that successful investing requires curiosity, diligence, patience, and discipline. Peter Lynch's approach blends practical observation with rigorous analysis, focusing on companies you know and understand. From retail stores to distressed companies, overlooked mutual funds to everyday experiences like restaurants, opportunity is everywhere. The magic is in spotting it, doing your homework, and staying committed to strong fundamentals. This final chapter leaves readers with a powerful message. Investing is not about luck, tips, or timing the market perfectly. It is about disciplined research, learning from mistakes, and continually checking and refining your decisions. Apply these principles consistently, and ordinary investors can achieve extraordinary results. The end. If you enjoyed this detailed journey through beating the street and want more insider investing strategies, rare insights, and practical tips distilled from the world's top investors, make sure to subscribe. By subscribing, you won't miss the next deep dive summaries, audiobook-style breakdowns, and actionable lessons designed to help you grow your knowledge and your wealth step by step. Your next great investment idea could be just a video away. Hit subscribe and join the journey.